If you are self-employed or run a small business without full-time employees, you've probably heard about the Solo 401k plan. But here's something a lot of people don't realize. The Roth Solo 401k plan option can be a game changer. It gives you high contribution potential, tax-free growth, and the flexibility to invest in things beyond the typical stocks or mutual funds. Today, I'm going to walk you through exactly how it works, how much you can put in, why it really matters, and what to watch out for so you don't make any costly mistakes. Hey, I'm Adam Bergman, tax attorney and founder of IRA Financial. For the last 15 years, I've helped thousands of entrepreneurs and solo business owners use retirement plans strategically, not just saving, but actively building tax-efficient wealth. If you really want to take control of your retirement account, this plan is the one you should understand. So let's start with the basics. A solo 401k is designed for self-employed individuals and small business owners without full-time employees. Unlike traditional IRAs, it allows much higher contribution limits because you can contribute both as the employee and as the employer. This means more money compounding for your future. I've linked a video in the cards that dives deeper into the solo 401k plan. But today, we're focusing on the Roth option and why it can be such a game changer for retirement savings. With a Roth Solo 401k plan, you make contributions with after-tax dollars, and the growth inside the account is all tax-free. When you take qualified distributions in retirement, you pay no federal income tax on the withdrawals. That certainty of knowing your retirement dollars can be withdrawn tax-free is huge for people who expect to be a similar or higher tax bracket later in life. Because numbers actually matter, let's go over 2025 contribution limits. The employee elective deferral limit is $23,500 for those under the age of 50, $31,000 if you're over 50 years old. Beyond the employee deferral, your business could add employer profit-sharing contributions up to a percentage of compensation. For 2025, the total combined contributions, employee deferrals plus employer contributions, can reach roughly $70,000 if you're under 50 and $77,500 if you're 50 and over. For those ages 60 and 63, an additional special catch-up is also available. This means you could potentially fund a Roth account with tens of thousands more each year than what a standard Roth IRA allows. So how does the Roth Solo 401k plan actually work? There are two pieces to focus on: the contribution mechanics and the investment mechanics. First, the contribution mechanics. As the employee, you can defer up to the elective deferral limit I just mentioned. You choose whether that employee contribution goes into the traditional pre-tax bucket or the Roth bucket of the plan. Then, in addition, the business can make an employer profit-sharing contribution in pre-tax or Roth, typically up to 25% of your compensation under plan rules or 20% if self-employed. Those employer contributions are generally pre-tax unless the plan permits designated Roth employer contributions. Combined, these two pieces are what allows the high annual total. Second, investment mechanics. One of the biggest benefits of a solo 401k is investment flexibility. Unlike a corporate 401k plan that may limit you to a handful of mutual funds, a solo 401k can allow you to invest in alternative assets such as real estate, metals, cryptocurrencies, and much, much more. That means you can direct substantial Roth protected capital into alternative assets that often aren't available inside a standard brokerage account. Let's walk through an example. You're a consultant under the age of 50 earning $150,000 a year. You elect to defer $23,500 as an employee into your Roth Solo 401k. Your business then contributes profit sharing equal to 25% of your compensation. Let's say that adds another $37,500. You now have $61,000 invested in this year into your Roth Solo 401k. That money grows tax-free and can be withdrawn tax-free in retirement. Now, some practical steps to implement a Roth Solo 401k properly. First, confirm eligibility. Solo 401k plans are for business owners with no full-time employees. We discuss eligibility more in this video. I've linked in the cards. Second, choose a plan provider that supports both the Roth option and the self-directed investments you want. Not every platform or custodian supports alternative assets or after-tax sub-accounts. So this choice really matters. Third, set up clear sub-accounts and bank accounts if you plan on doing conversions. Having separate sub-accounts makes record-keeping and Roth conversions cleaner. Fourth, coordinate timing for contributions and conversions with payroll and tax filing deadlines. This is where most people trip up. There are a few more technical details worth understanding. If you plan to use the mega backdoor Roth solution for your contribution, you need after-tax contribution capacity and the ability to perform in-plan Roth conversions or in-service rollovers to a Roth IRA. We discuss this solution more in this video. Also, remember that profit-sharing contributions are based on compensation formulas. In a solo business, that often means calculating contributions as a percentage of net compensation on a Schedule C. Those computations can be counterintuitive for new business owners, so work with a plan specialist or tax professional to ensure your numbers are accurate. Now let's cover some pros and cons so you can decide whether this is for you. The pros: you have much higher contribution limits in a Roth account. You have tax-free growth and access to self-directed investment flexibility. This is especially powerful for real estate or private business investments that can compound tax-free over long periods. If you expect to be in a higher tax bracket in retirement, converting current savings into Roth status gives certainty and powerful estate planning benefits. On the flip side, cons include complexity and compliance requirements. A solo 401k requires careful record keeping and timely filings if assets generate unrelated business income tax, also known as UBIT, or if you're using leverage. There's also the administrative burden. Plan documents must be properly drafted, and conversions and rollovers must be recorded correctly to avoid inadvertent tax reporting. If you have wages and employees or plan to hire full-time help, the solo 401k plan can become disqualified for that plan structure, and you'll need to convert to a more standard 401k plan. Another important consideration is prohibited transactions. A solo 401k must never be used to benefit you personally outside of the retirement rules. That means you can't buy property from yourself or use the plan to pay family members in ways that create a self-dealing transaction. Those mistakes can be costly, so compliance and good counsel are essential. Some clients have asked, is this just for advanced investors? The short answer is no, but you should not go at it alone. If you're just starting out, a Roth Solo 401k can be a powerful tool once you understand the rules and set it up correctly. If you're an experienced investor, it opens doors to scale Roth balances dramatically. If you're ready to explore your own options, schedule a free consultation using the link in the description. One conversation could be the first step towards building the retirement you want and taking full control of your financial future. If you found this helpful, please subscribe to our channel. Every week, we share strategies to help you take control of your retirement, understand investments, and grow your wealth effectively. Thanks so much for watching.